In the spring of 2000, a fashion website burned through $135 million in 18 months. Not 18 years. 18 months. That's $250,000 every single day. $7.5 million a month. Gone. The company was called Boo.com, and they didn't fail because they were stupid. They failed because they moved too fast to notice they were building something nobody could use. This is the story of how speed became the enemy, how moving fast broke everything, and how 18 months of frantic execution taught Silicon Valley a lesson it would immediately forget. The year is 1998. 3 Swedes walk into the wreckage of the dot-com landscape with a plan. Ernst Malmsten and Kajsa Leander had already built and sold Bokus.com, a successful online bookstore in Sweden. They knew how to execute in e-commerce. They understood logistics. They had credibility. Their new partner was Patrick Hedelin, a veteran investment banker. Together, they saw something the market was missing. Amazon sold books. eBay sold collectibles. But nobody was selling fashion online in a way that felt premium. Here's the problem they identified. Fashion is emotional. It's about touch, about fit, about how something makes you feel. Books are standardized products. A copy of Harry Potter is the same whether you buy it in London or Los Angeles. But a dress? A jacket? That's personal. The Boo.com vision was ambitious. They would create a global fashion platform that solved the emotional problem of buying clothes online. 3-dimensional product views you could rotate with your mouse. A virtual shopping assistant named Miss Boo who would help you find the perfect outfit. Personalization based on your style preferences. They would launch simultaneously in multiple countries, multiple languages, multiple currencies. This wasn't a website. This was a technology platform, wrapped in a fashion experience, wrapped in a global expansion strategy. In 1998, this sounded revolutionary. By 1999, venture capitalists were writing checks so fast the ink barely had time to dry. Boo.com raised $135 million from some of the most sophisticated investors in Europe and America. The founders made one critical assumption. Speed was the competitive advantage. Get big fast. Launch everywhere at once. Outspend the competition before they even knew competition existed. They didn't realize speed would become the thing that killed them. Let's talk about what Boo.com actually built. The website launched in November 1999, and it was genuinely impressive. You could view products in 3 dimensions, rotate a jacket on your screen, zoom in on details. This was cutting-edge technology in 1999. Nobody else was doing this. Miss Boo, the virtual shopping assistant, appeared in the corner of your screen offering style advice. She was personalized. She remembered your preferences. She felt futuristic. The site supported multiple languages, multiple currencies, local payment methods. They weren't just translating text. They were building localized shopping experiences for 18 different countries. The problem was sitting in every customer's home. Most people in 1999 were accessing the internet through dial-up modems. Connection speeds averaged about 56 kilobits per second. That's roughly the speed it takes to download a high-quality photo today in about 30 seconds. Boo.com's homepage was packed with graphics, animations, 3-dimensional product views, and interactive features. The average page took 30 seconds to load, sometimes longer. Imagine you're shopping online in 1999. You click on Boo.com. You wait. And wait. Your modem makes that distinctive screaming sound. You watch a loading bar crawl across your screen. 30 seconds later, Miss Boo appears to help you shop. But you've already left. The technology was ahead of its time, not in a good way. In a literally unusable for the market that exists right now way. They knew. Internal testing showed the performance issues immediately. The founders received feedback from early users that the site was too slow. But they had a different problem. They'd spent months building this technology. They'd made promises to investors about innovation and premium experience. They'd committed to a November launch date across multiple markets simultaneously. And they'd already started spending money at a rate that required massive growth immediately. So they launched anyway. This is where the speed trap closes. They needed to move fast to justify the spending. But moving fast meant launching a product that wasn't ready for the market that existed. Slowing down felt like death. So they chose speed, and speed chose their fate. Let's talk about where $135 million goes in 18 months. Boo.com didn't just have offices. They had headquarters: London, New York, Paris, Munich, Stockholm, Amsterdam. 6 major cities. Premium office space in every location. Staffed with expensive talent. The logic made sense in the context of their strategy. They were launching globally. They needed local teams who understood local fashion markets, local payment systems, local logistics. But here's what actually happened. Coordination between offices was a nightmare. Time zones made communication fractured. Decision-making slowed down, even as spending accelerated. They employed 400 people at peak. 400 people coordinating across 6 cities to sell clothes online. The average salary was high. These weren't warehouse workers. These were fashion buyers, technology specialists, marketing executives, designers, managers, coordinating the coordination. Travel expenses alone were staggering. Flying teams between cities, for meetings, coordination, planning sessions. They spent millions on marketing before the site even launched. Full-page ads in fashion magazines, billboards, launch parties in multiple cities. They hired talent at premium rates because they needed to build fast and couldn't wait for cheaper alternatives. Every decision made sense in isolation. Premium talent delivers better results. Global offices enable local expertise. Marketing builds brand awareness before launch. But the combined effect was a burn rate that required massive revenue immediately. They needed to sell a lot of clothes very quickly. The site launched in November 1999, the holiday shopping season. Perfect timing. Except the site was too slow. Many users couldn't access it at all. The technology requirements exceeded what most computers could handle. Some browsers weren't supported. The first sales figures came in. They were bad. Really bad. The company was burning $7.5 million a month. Revenue in the first months was measured in hundreds of thousands, not millions, hundreds of thousands. The unit economics were catastrophic. They were spending roughly $30 to acquire each customer. The average order value was $100. Margins on fashion retail are typically around 40%. Do that math. Spend $30 to acquire a customer who generates $40 in gross profit on their first purchase. That looks okay, until you account for all the other costs. Technology development, office expenses, salaries, logistics, and until you realize that fashion e-commerce in 1999 had terrible repeat rates because the experience was clunky and returns were complicated. By early 2000, 3 months after launch, the company needed more money. They went back to investors. This is where the story gets darker. Imagine you're an investor in early 2000. The dot-com market is starting to show cracks. Amazon's stock has dropped. Pets.com is struggling. The NASDAQ is getting volatile. Boo.com comes to you asking for more money. They've already burned through most of $135 million in 18 months. Their revenue is a tiny fraction of their spending, but they have a pitch. We just need to get through this difficult period. The technology is built. We're seeing growth. The market for online fashion is emerging. We're the leaders. We just need bridge financing. Some investors wrote checks, not enough. By March 2000, Boo.com was in trouble. They started cutting costs, laying off staff, closing offices. But here's the trap they'd built for themselves. Their entire model required scale. The technology platform cost millions to develop, whether they had one customer or 1 million customers. The offices, the staff, the infrastructure, these were fixed costs that made sense only at massive volume. Cutting costs meant reducing the scale that justified the costs in the first place. There were moments where different choices might have changed the outcome. They could have launched in one market first, proved the model, then expanded. They could have built a simpler site that worked on slower connections, focused on the shopping experience rather than technological innovation. They could have targeted a profitable niche instead of trying to be everything to everyone everywhere at once. But each of these options required something they didn't have: time. The spending had created a clock that was running out. Every month of operation cost $7.5 million. Every pivot required months of development. Every strategic shift meant abandoning sunk costs. By May 2000, the dot-com crash was undeniable. The Nasdaq had lost a quarter of its value. Investor appetite for internet companies evaporated overnight. Boo.com was burning through their last reserves of cash. They needed $20 million immediately to survive the next few months. They found 0 investors willing to write that check. On May 18, 2000, 18 months after raising $135 million, Boo.com filed for liquidation. The asset sold for a combined $375,000. $135 million became $375,000 in 18 months. The technology platform that cost tens of millions to develop sold for pennies. The brand that they'd spent millions promoting was worthless. The global infrastructure was dismantled. 400 people lost their jobs. Investors lost everything. Here's what makes the Boo.com story haunting. Nobody involved was incompetent. The founders had successfully built and sold an e-commerce company before. They knew the space. They understood the challenges. The investors were sophisticated. These weren't amateur angel investors throwing money at a crazy idea. These were experienced venture firms who'd built successful companies. The employees were talented. The technology they built was genuinely innovative. So what went wrong? Speed. Not just moving quickly, but the specific dynamic where speed creates commitments that require more speed, which creates more commitments, which requires even more speed. They committed to a global launch. That required building infrastructure in multiple countries simultaneously. That required raising massive capital. That capital created expectations of rapid growth. Those expectations required aggressive marketing spending. The marketing spending increased the burn rate. The burn rate required revenue growth that demanded the global launch be successful immediately. Each decision was rational in the context of the previous decision. But the chain of rational decisions created an irrational outcome. This is the speed trap. You start moving fast to gain advantage. But speed creates its own gravitational pull. It demands more speed to justify itself. And eventually, you're moving so fast, you can't see what's in front of you. Boo.com built technology for 2002 and launched it in 1999. In any other context, this is being ahead of your time. In the context of their burn rate, this was suicide. They needed the market to exist immediately. It didn't. By 2002, broadband was becoming common. Connection speeds were faster. The technical barriers that made Boo.com unusable were disappearing. But by 2002, Boo.com was dead. And here's the cruel irony. Many of the ideas Boo.com pioneered became standard practice in online fashion retail. Three-dimensional product views, virtual try-on tools, personalized shopping assistants powered by AI. These all exist now. They all work. Companies make billions using these exact concepts. Boo.com was right about where the market was going. They were just wrong about when it would get there. And in the speed trap, timing is everything. $135 million in 18 months. That's the headline. The shocking number that makes the story memorable. But the real story is quieter. It's about talented people making reasonable decisions that compounded into catastrophe. It's about how market momentum can override market reality. It's about the difference between being visionary and being early, and how that difference is measured in bankruptcy filings. The dot-com crash of 2000 killed hundreds of companies. Most of them deserved to die. They had no business model, no path to profitability, no reason to exist beyond internet and growth. Boo.com was different. They had a genuine insight about the future of retail. They built innovative technology. They saw where the market was heading. They just moved too fast to notice the market wasn't there yet. And by the time they realized it, the speed trap had closed. There was no slowing down. There was no stopping. There was only the crash.